June 25, 2002. Early morning. You're sitting in your office on the 29th floor of WorldCom's headquarters in Clinton, Mississippi. The phone rings. You already know what they're going to say. Cynthia Cooper's team has been working through the night. They found it, all of it. The numbers that weren't supposed to exist. $3.8 billion. Hidden in plain sight inside the company's own books. You set the phone down. You look out the window at a town that WorldCom built. A town that you built. And you understand, with complete clarity, that everything ends today. You grew up in a small town in Mississippi. Not poor, not rich. Just ordinary. The kind of ordinary that makes you hungry for something more. But you can't name what that something is yet. Your name is Bernie Ebbers. And from the beginning, you were never the smartest person in the room. You knew that. But you had something the smart people didn't. You could make anyone believe in you. You sold milk door to door as a kid. You bounced between jobs, hotel manager, bartender, high school basketball coach. You were 43 years old and still hadn't found your thing. Then, in 1983, you and a few friends sat around a table at a diner in Hattiesburg, Mississippi. Someone pitched an idea about this new thing called long-distance telephone services. Deregulation had just cracked the market open. There was space for newcomers. You didn't know anything about telecommunications. That didn't stop you. You became CEO of a tiny startup called ELDS, Long Distance Discount Services. And you did what you always did. You talked people into things. Investors, partners, banks, regulators. Within a decade, you turned that diner conversation into a company worth billions. The secret wasn't technology. It wasn't innovation. It was acquisitions. You bought competitors. Then you bought their competitors. 65 companies in 15 years. Each purchase made WorldCom look bigger, stronger, more unstoppable than the last. Wall Street loved it, and you loved Wall Street loving it. There was one thing, though, that never changed from your days selling milk door to door. You didn't like looking closely at the numbers. You were a deal maker, a visionary, a charismatic force of nature. The details, the accounting, the balance sheets, the quarterly reports, that was for other people. People like Scott Sullivan, your CFO, the numbers man, the one you trusted completely. That trust will be the most consequential decision of your life. By the late 1990s, WorldCom is the second largest long-distance telephone company in America. You've just completed the largest corporate merger in U.S. history. $37 billion to acquire MCI. Your name is in every financial newspaper in the country. Analysts call you a genius. Forbes puts you on the cover. You are, by any measure, unstoppable. And then the dot-com bubble bursts. It's 1999, then 2000. The entire telecommunications sector starts hemorrhaging. Internet demand, which everyone predicted would grow forever, flatlines. The fiber optic cables you laid across continents are carrying a fraction of the traffic you projected. Your stock price, which once hit $64 per share, starts sliding down to $50, then $40, then $30. Here is the problem. You've personally borrowed over $400 million, using your own WorldCom stock as collateral to fund investments and purchases. As the stock falls, the banks that lent you that money start calling. If the stock keeps falling, they will liquidate your shares to cover the loans. If they liquidate your shares, The market will see it as a signal of collapse. And if the market panics, you can't let it get that far. So you go to Scott Sullivan, your numbers man, your most trusted person in the building. You tell him the situation, the pressure, the expectations, the Wall Street analysts who have already baked a certain earnings number into their models, the investors who are counting on a certain story. You don't tell Scott to commit fraud. You never say those words. What you say is something closer to, we need to find a way to make these numbers work. And Scott Sullivan, brilliant, meticulous, loyal Scott Sullivan, finds a way. The method is almost elegant in its simplicity. Operating costs, the fees WorldCom pays to other phone companies to use their networks, are supposed to be recorded as expenses. Expenses reduce profit. Lower profit disappoints Wall Street. What if instead of recording those costs as expenses, you recorded them as capital investments? Capital investments are spread out over years. They don't hit the profit line immediately. The company looks more profitable than it is. The stock holds. The loans stay safe. It's an accounting reclassification. That's what Scott calls it internally. Not fraud, a reclassification. The first quarter it works. It works. You feel something that is hard to describe. Relief, yes, but also something else. A kind of confirmation. The system has more flexibility than people realize. You just have to know where to push. $771 million moved in the first pass. No one notices. So you do it again. 2001. WorldCom is the backbone of the American Internet. 1 in every 2 emails sent in the United States travels through your infrastructure. You carry more internet traffic than any other company on Earth. Your company employs 80,000 people. You own a yacht, a private jet, a working ranch in Canada, 500,000 acres. You own a hockey team, and here is what you think, sitting in your office, looking down at Clinton, Mississippi. I built this, every single piece of it. From a diner conversation to the backbone of the internet. Nobody gave me this. I created it. The analysts who question your projections, they don't understand the long game. The journalists who write skeptical pieces about telecom valuations, they've never run a company in their lives. Your board of directors, they trust you. They've always trusted you. The reclassifications continue. Quarter after quarter, Scott and his team move the numbers. The amounts grow. $771 million becomes $1 billion. $1 billion becomes $2 billion. You tell yourself it's temporary. Once the market recovers, and it will recover, markets always recover. You'll correct the books. It'll sort itself out. You just need to buy time. There's a moment, sometime in 2001, when an internal accountant named Troy Normand approaches Scott Sullivan with questions. He's noticed inconsistencies. The numbers don't match what he expected. Scott tells him it's been approved. Troy walks away. You never know this conversation happened, and that, in some ways, is the most important detail of this entire story. Late 2001. You start waking up at 3 a.m., not every night, just some nights. The nights when a particular thought surfaces before you can push it back down. How big has this gotten? You don't ask Scott directly. You don't want the specific number. Knowing the specific number makes it real in a different way. The SEC announces it's looking into the accounting practices of several major telecommunications companies. Routine inquiries, they say. Industry-wide review. You tell your team, cooperate fully. You believe, you need to believe, that there's nothing to find, that what Scott's team has done is defensible. Gray area, maybe. Aggressive accounting, sure, but defensible. Then Arthur Anderson, your external auditor, collapses, taken down by the Enron scandal. Your audit firm is gone overnight. A new firm comes in. Fresh eyes, fresh questions. You stop sleeping through the night entirely. There is a particular kind of dread that is unique to people waiting for something they know is coming but cannot stop. You know this dread now. It lives in your chest. You eat with it. You present to the board with it. You smile for cameras with it. WorldCom announces it will lay off 6,000 employees, then 17,000. The stock falls below $10, below $5, and your loan collateral is evaporating. The banks are circling. Your personal financial exposure is catastrophic. And somewhere in the basement of WorldCom's headquarters, a woman named Cynthia Cooper, Vice President of Internal Audit, is working with her team after hours, on nights and weekends, without telling senior management. She'd been asked to delay her audit. She didn't. She found the first thread and she pulled it. You don't know her name yet, but she knows yours. June 20, 2002. Cynthia Cooper walks into the office of the Audit Committee Chairman and presents what her team has found. $3.8 billion. Not a rounding error, not a gray area, not an aggressive reclassification. $3.8 billion in operating costs, systematically moved into capital expenditure across multiple quarters, disguising massive losses as profit. The audit committee meets. Then the board meets. On the morning of June 25th, Scott Sullivan is called in. He doesn't deny it. He can't. The documents exist. The journal entries exist. The signatures exist. Scott is terminated that day. You resign as CEO. 5 days later, WorldCom files for bankruptcy. The largest corporate bankruptcy in American history at that time. $107 billion in assets. Gone. 80,000 employees. Thousands of retirees who held WorldCom stock in their pension funds. Individual investors across the country who believed in the story you told them. All of them, in that moment, lose something they cannot get back. You are at home in Clinton when you get the final call. You sit down, and this will stay with you. Your first thought is not about the employees or the investors. Your first thought is about your own stock, your own loans, your own exposure. That thought will follow you into every courtroom, every deposition, every interview for the rest of your life. You put on a suit on the day you turn yourself in to federal authorities. You've worn a suit almost every day for 20 years. This one feels different. The trial begins in January 2005. Your defense is simple. You didn't know. Scott Sullivan was the CFO. The accounting was his domain. You were the visionary, the deal maker, the CEO who focused on strategy. You trusted the people below you to handle the details. This is, in some ways, true, and in another way, the way that matters legally, it isn't. Because the pressure came from somewhere. The culture came from somewhere. The unspoken understanding that the numbers needed to work, that questions shouldn't be asked too loudly, that came from the top of the building. It came from you. The jury deliberates for 8 days, guilty on all 9 counts, fraud, conspiracy, filing false statements. The sentence, 25 years. You are 63 years old. You will spend the rest of your functional life in federal prison. Somewhere, in the quiet of a cell, you think about the question everyone asks. Did you know? And the honest answer. Not the legal answer, not the answer your lawyers coached you on, but the real answer is that you knew enough. You knew the stock price mattered more than the accuracy of the books. You knew Scott was under pressure to produce certain numbers. You knew you never asked him how. There are 30,000 WorldCom employees who lost their jobs in the bankruptcy. There are pension fund holders who lost their retirement savings. There are small investors who put money into WorldCom because they believed in American telecommunications, in American business, in the story you told on television and in analyst calls and in press releases. Do you think about them? The honest answer, the one you've never said clearly on record. Not as much as you should have, not nearly as much as you should have. And that is what Bernie Ebbers lived through. Now we step back, because the WorldCom collapse is not just a story about one man's ambition. It's a story about how a system, designed with multiple layers of protection, failed at every single layer simultaneously. The external auditors signed off on numbers they didn't verify deeply enough. The board of directors asked too few hard questions of a CEO they admired too much. Wall Street analysts kept issuing buy ratings on a company whose fundamentals were deteriorating visibly. The SEC, stretched thin and outpaced by the speed of the boom, arrived late. And inside the company, an entire culture had evolved where you didn't challenge the story, where the narrative of WorldCom's invincibility had become more important than the reality of WorldCom's finances. The one person who broke that culture was Cynthia Cooper. She is not in this story as the hero of a Hollywood ending. She's in this story because of one simple fact. She did her job. She audited the books. She refused to delay when asked to delay. She followed the numbers where they led, even when they led somewhere she didn't want to go. She was named one of Time magazine's Persons of the Year in 2002, alongside the whistleblowers of Enron and the FBI. The WorldCom collapse alongside Enron directly triggered the Sarbanes-Oxley Act of 2002, new rules requiring CEOs and CFOs to personally certify the accuracy of financial statements, new protections for whistleblowers, new criminal penalties for executive fraud. Bernie Ebbers died in February 2020 at age 78, after being released early on compassionate grounds due to his health. He served 13 years of his 25-year sentence. Scott Sullivan cooperated with prosecutors and received a 5-year sentence. The $11 billion gap in WorldCom's books was never recovered. Here is the question I want to leave you with. The fraud started with one reclassification, one decision to buy time. If you were Scott Sullivan and your CEO implied the numbers needed to work, at what point do you say no? And do you think, honestly, that you actually would? Drop your answer in the comments. Next week, Enron, the company that didn't just move numbers around. They invented entirely new ways to make losses look like profits. And the people who almost stopped it 4 years before the whole thing collapsed.